This is our Forex blog for October 26, 2011, and like most days we really want to buy the super strong currencies versus the weakest ones, and we want to sell the weakest ones versus the strong. Our main concept is we trade with a trend until the market moves statistically too much, and then we wait for the momentum to slow, and then we look for counter trend trades. That's our system in a nutshell. What is statistically too far? It's above our upper or lower 2.0 containment bands. It's above the daily statistical high or low for each currency, and it's after our FX trend reversal signals show up. This could be a 2, 3, 4 day up move, and it's run out of steam, and when those signals show up, usually the market reverses. So those are, we want to continue to trade with the trend until you find reversal patterns, and then wait for the momentum to slow down. You don't want to short the strongest currency or buy the weakest currency, because that rarely works. You want to look for patterns like double tops, double bottoms, to more safely get into counter trend trades, because that way you can have tight stops. And most of the time when the market has moved too much, it's likely to pull back to the 38% Fibonacci level, which gives you a good potential profit target for a small amount of risk that you take. So on the top we have all the main pairs, bar by bar statistical strength or weakness of each, which is composed of 5 of our best statistical tools. 3 of them measure the direction that each of them is going. 1 of them measures the intermediate time frame intensity, and the last one measures the bar by bar intensity. So anytime you have a reading at or above the dotted 80 level, you have the majority of those currencies going up or down, and with a lot of intensity. In a perfect world, the easiest way to trade is when the real-time weakness coincides with the daily, weekly, and monthly trend, which is down. You can see the yen, which did have a downtrend, had shifted back to an uptrend. The weekly and monthly trend are slightly up, and you can see more strength than weakness, more strength than weakness, more strength than weakness. This is basically the pattern that you want to look for on this. You're not looking at the last bar and just because it's green looking to buy. You're looking to see previous swings of the day, and is there more intensity to on the way up or down. So if you see a lot of intensity on the way up followed by less weakness than strength, and the longer term trend is up, you are waiting for this weakness to subside a little bit, like right here, and you're expecting and anticipating the trend to continue. As you can see, it did right here. A little bit of weakness, the trend continued for an hour here. A little bit of weakness, half the weakness that there was strength. It continued, unfortunately only for 15 minutes. A little bit of a pullback with no intensity, and this is what typically happens. Just like you see here with the pound, a lot of weakness followed by very little amount of strength. The weakness continues for an hour, 15 minutes of weakness, or strength I should say, the weakness continues. Now in the pound, it's not as high of an odds trade because the weekly and monthly trend is up. Here in the CAD, you have a lot of weakness, all the longer time frame trend is down, followed by almost no strength. That trend is very likely to continue, and it does here for an hour. And so that's how you use the currency meter. Looking at this today, the dollar was weaker than the yen, and you had a little bit of strength here. In the euro, it's less strength than weakness, and then you have a little bit of weakness right here. Because the longer time frame trend is up, you might at 3:30 look to buy the euro, and at 3:30 right here you see the dollar was weak followed by very little amount of strength. So let's take a look at 3:30 with the euro dollar using our range charts, which makes it a little bit easier. Let's get rid of this. Is from yesterday. I'm going to scroll over to today. And at 3:30 the currency was underneath the hourly, and usually that's a sign that the trend is going to be down. You can see the previous week's highs right here, and it's been kind of chopping around the hourly right here. It came up to the hourly, came back down, did not make a lower low, and at 3:30 right here, if you wanted to go long, it's a little risky trade, but once it breaks above the previous week's high and the hourly moving average, you can see it went up about 25 pips. Not the biggest trade in the world, but the currency meter did show a very high probability signal, and you would have made money on it. Strength followed by very little amount of weakness, the strength is likely to continue, and you had the exact opposite pattern in the other pair. Now it's always best when you have a currency that's weak on all time frames. Here the New Zealand is extremely weak at 2:30. 1 5-minute bar of just mild strength. At 3, it's very likely that the New Zealand's going to get weak again. Here we have the yen was very strong, between the dollar and the yen, which are the two most pairs that most of us trade, you want to anticipate selling the New Zealand yen at 3 o'clock. Bringing up the chart here, you can see at 3 o'clock this currency is underneath the hourly. This thing has come back up to the hourly right here, and it's finding resistance. Wait for it to break down, and you can see you shorted this around 60.55, and the trend went all the way down to 31. It went down 24 pips. Now, no one ever catches every single pip. If you use our trailing stop, you might have got out of this at 41 here. But the point is, you made a little bit over 10 pips by anticipating the future trend. Let's look at the CAD here. A lot of weakness, followed by almost no strength. 530. It's very likely to be strong. The yen was the stronger of the two between the dollar and the yen, and so after about 5:15, you're looking to sell the CAD yen. Bringing up the CAD yen chart, and you're not going to have all wins. Here's 5:30 right here. This one had gone underneath the hourly, came back up and did a retest at the hourly. Very high probability trade. You can see if you shorted around 74.80, this fell to fell about 23 pips. So again, you're never going to catch every single pip. The majority of the time you're going to draw your fibs on the first wave, and always exit half your trade at the fib target, especially if it doesn't have that much momentum. Then maybe you got out at the 20-day moving average, previous week's low. It should stay underneath there. When it went above there, you're out here at 75. So your average exit might have been 64, 65. You're short somewhere at 79. You made about 14 pips on there. Again, a lot of times you're not always going to catch 30, 50 pip moves. Some days when currencies trend all day long, it's easy. Anybody can make money on those days. But on days where the market has a little bit more choppiness and shorter term 30-minute to hour-and-a-half trends, our tools allow you to trade regardless. Now here's the Swiss. We have the real-time strength is up clearly, more strength than weakness, more strength than weakness, more strength than weakness. And now guess what? At 7 you have more weakness than strength. So that the next wave is more likely to be down. But before that, especially coming up to 3 right here, very strong Swiss. The monthly trend's down, but the weekly trend's up. I pretty much ignore the monthly trend, with the exception of I use it to decide how many lots to trade. If the weekly and monthly trend are both up and the real-time momentum is up, I will trade more lots. If the monthly trend's down, the weekly trend's up, I don't trade more than my normal lots. So the only way I use the monthly trend myself is to decide how big a bet I want to put on the currency. Because when you're trading, when all the time frames line up, you tend to have more 30 to 50 pip moves. If you trade more lots, you make a lot more money when right, and it also tends to be a higher winning percentage in my opinion. So looking at this, the Swiss, we're looking to buy it here at 3 after a little bit of weakness. Typically, after you have a momentum move up or down, if the longer term trend is in the direction of the momentum move, typically you get 30 minutes to an hour and a half of pullback before the trend comes back. So this is the minimum time frame to wait for a pullback, maybe about 25-30 minutes. You can see a little bit before 3 it started to go green, and then the intensity came back in. Clearly the dollar is a better currency to trade than the yen, because the yen's weekly monthly trend had shifted up. So coming up to 3, we're looking to sell the dollar Swiss. Now here's 3, and this currency is underneath the hourly, and you have another added benefit here of a narrow range 7 pattern. Anytime you see a narrow range pattern like that, it means volatility for that 4-hour period, the previous one, was less than the previous 7 bars. So it's the lowest volatility period in over a day. And typically when currencies are underneath the hourly and they break down underneath there, you're going to get some trends. So this 3 o'clock trade right here, when it failed to go above the resistance area of the hourly moving average, you might have been a little bit more of an aggressive trader to short right here. And usually when you have a narrow range pattern, you're going to get a bigger trend. I would draw my fibs off the previous swing down to get an idea of where my profit target is. And this is one of those things where you can see it went right to the 1.618 fib target in our lower containment band. But the majority of the time, this is the minimum profit target you're going to get. You're going to go short around 87.80, and your first exit, unless it carves through it like this one did here, is at 50. So you can see we quickly made 50 pips. and the trailing stop, more than likely would have got out of the second trade, somewhere up here at 51. Very high probability trade. And you could have also traded it against the pound, which was incredibly weak today. The only downside of shorting the pound is that the longer time frame trend is up. So you can take these trades, and if they just keep going and going and going, you stick with them, but you go into the trade knowing that you're less likely to make a lot of money on these trades. Some days like today, the trend continues, but when the longer time frame trend is up, it might only be weak for half an hour, an hour. So you could have also looked to sell the pound Swiss here. This is not a currency we leave running overnight, so let me bring it up here. And you can see at 3 o'clock this one, because the pound did continue to the downside. Let's scroll back to 3 o'clock here. You can see this was an astronomical win compared to some of the other ones. This currency had found a double bottom right here, didn't bounce, and you can see just kept going down and down and down. It fell about 100 pips. There were 90 pips from that breakout area, and the currency meter showed that the Swiss was very strong. You could have also traded that pound against the strong yen by selling the pound yen coming up to 3. This one came back down and found the hourly right here. It also has a narrow range pattern. The odds are improved because we have a narrow a trend reversal signal right here. The big yellow dots are very high probability, and your next profit target is a weekly pivot in a 10-day moving average down here. So if you sold this breakdown right here at 60, you're out when it stalls here at the 10-day moving average. So it's almost a 30 pip move on that trade as well.